Most UK crypto investors are overpaying tax because they don't realise how much of their profit HMRC is entitled to, or even how they could legally reduce that profit. I speak to crypto investors every week who didn't even know they could claim expenses, or that swapping one coin for another can trigger tax. So in this video, I'll show you exactly how to keep more of your crypto profits legally. We'll cover how crypto is taxed in the UK, how to use your tax-free allowances properly, and the key strategies that can significantly reduce your tax bill, including timing your disposals and offsetting losses correctly. And if you're finding this useful, make sure you're actually subscribed, because crypto tax mistakes can cost thousands, and most people only realise after it's too late. Let's get into it. Now, before we dive into the strategies, a quick refresher on what exactly triggers tax in crypto, because understanding this is the foundation for managing and minimising your tax bill. One of the biggest misconceptions in the UK is, I didn't withdraw to my bank, so I don't owe tax. Wrong. Under UK law, you trigger tax when you dispose of crypto. Now, a disposal includes things like selling crypto for GBP. You might be swapping one crypto for another, spending crypto, gifting crypto, unless it's to your spouse. So, yep, swapping ETH for SOL is taxable. For example, you bought 5,000 of ETH, it's now worth 8,000, you swap it for BTC. That's a £3,000 capital gain. It's reportable, even though no cash moved. But don't worry, I'm going to show you exactly how to make the most of the tax-free options to keep things efficient. And shortly, I'm going to cover a real-life example of how to save tax, plus a checklist for you. So you understand what classes as a taxable event. The next question is, how do you legally reduce the tax you actually pay? Now, this is where your capital gains tax allowance becomes incredibly powerful, because for the 25-26 UK tax year, that's from 6th of April 2025 to the 5th of April 2026, every individual gets a £3,000 tax-free allowance. So that means that you can realise up to 3,000 of total capital gains from crypto, from shares, from other investments, without paying any CGT at all. So, for example, let's say you bought Bitcoin and you bought it at 10,000, and then you've later sold it for 12,500, and you've got no other disposals this year. There's no CGT to pay. If you make a gain of 3,500, you'd only pay tax on the 500, since that's the portion that's exceeded the allowance. That's a crucial distinction, because it means the first 3,000 of gains each year is effectively tax-free. And later on in this video, I'll share a hidden way so you can double this allowance, so stay tuned for that. Now, here's the part most crypto investors get wrong. This allowance doesn't roll forward. If you don't use it before the 5th of April, it's gone forever, which means if you sit on large gains for years and then sell everything at once, you've wasted multiple years of tax-free allowances. Instead of using your £3,000 per year tax-free, you've compressed everything into one taxable event, and that can cost you thousands unnecessarily. And this is why crypto tax isn't just about what you sell, it's about when you sell it. And in the next section, I'll show you how timing your disposals properly can just dramatically reduce your tax bill. Now, this is where crypto tax can become much more expensive than people expect, because not all crypto is taxed under capital gains tax, your CGT. Some crypto is taxed as income tax instead, which can be as high as 40% or even 45%, depending on your income. And the reason comes down to one key distinction. If you buy crypto and it grows, that's an investment, so it's taxed under capital gains tax. But if you're given crypto as a reward, a payment, or earnings, HMRC treat it like income and they tax it as salary. This includes things like staking rewards, so where you lock up your crypto to help run a blockchain network, and in return you're paid rewards in crypto. There's mining income, where you receive crypto for validating transactions using your computing power. Then there's airdrops. So these are free tokens given to your wallet, often as part of a promotion or a new project launch. There's referral bonuses. So crypto you receive for referring other users to a platform. Then there's DeFi rewards. This is when you earn crypto interest or rewards from lending, liquidity pools, or yield farming. So, for example, if you receive £5,000 worth of crypto through staking rewards, then that 5,000 gets added to your total income for the year. Now, if you're already a higher rate taxpayer, that could mean £2,000 of income tax straight away. Now, here's the second layer, the hidden second layer that most people don't realize. If you later sell that crypto and it's gone up in value, you then pay capital gains tax on the increase. For example, you receive £5,000 worth of staking rewards, so that's taxed as income. Later, that crypto itself grows to 8,000 and you sell it. You now have a 3,000 capital gain, which is taxed under capital gains tax. So the same crypto gets taxed twice, but on two different parts. HMRC are literally taking 2 bites of the cherry. So first, income tax on the value when you receive it. Second, capital gains tax on any increase in value after that. It's worth understanding the distinction. It's crucial, in fact, because income-based crypto is taxed more heavily up front than investment gains. And that's why tracking the value of crypto when you receive it is just as important as tracking when you sell it, because HMRC looks at both. And by the way, I'm hosting my first ever live webinar on Wednesday, the 25th of March. So if you want to find out more about making tax digital, there's a link in the pinned comment below. So sign up. Now, this next bit is one of the most frustrating crypto tax rules, and it catches people all the time. It's called the 30-day rule, also referred to often as the bed and breakfasting rule, and not the good kind. If you don't know about it, it can completely ruin your tax planning. Now, let's say you bought Solana at 4,000. The price then drops to 2,500. So you sell it to try and minimize future losses. You're locking in what you think is a £1,500 loss. And that loss could be useful because losses can reduce the tax that you pay on other gains. But then 10 days later, you buy Solana again for 2,600. Seems sensible, right? You still believe in the investment. But HMRC steps in and says, you can't claim the full £1,500 loss because you rebought the same asset within 30 days. HMRC, because you've done that, they match your sale to the new purchase price instead. So your allowable loss is now just £100. That's a £1,400 tax loss lost. Try saying that 10 times fast. This rule exists to stop people selling crypto just to create artificial tax losses, then immediately buying it back. Which means if you genuinely want to use losses to reduce your tax bill, then timing is critical. Generally, you need to either wait at least 31 days before buying it back or buy a different crypto asset instead. Now, don't worry. Shortly, I'm going to show you legitimate strategies that you can use to reduce your crypto tax bill properly without falling into traps like this. And if you're watching this and you're realizing that you've had staking income, trading gains, or disposals you've not reported yet, or you just want it done properly, we help crypto investors calculate and report everything correctly. You can get a free quote with Helpbox using the link in the description, and we'll show you exactly what's required and how we can help. Because honestly, fixing mistakes early is far easier and far cheaper than fixing them later. Right, we've talked about the rules. Now, let's talk about how to pay less tax legally, because crypto tax is all about strategy. Here are 6 practical ways to reduce what you owe. So, number 1, harvest losses. Yeah, even the painful ones. Nobody likes seeing a coin down 70%, but tax-wise, that red number can actually help you. So at number 1, we've got harvesting losses. If you've got 15 grand gain on one coin, but 5 grand loss on another, sell the loss maker. your taxable gain becomes 10 grand instead of 15 grand. And if your losses are bigger than your gains, well, you can carry them forward indefinitely. But, and this is important, only if you report them. An unreported loss is a wasted loss. HMRC will happily ignore losses that you don't report, unlike income. Then at number 2, use your spouse's allowance. Now, earlier, I promised you a hidden trick that could actually double your capital gains tax allowance. In the UK, transfers between spouses are tax-free. So together, that's 6 grand. If you gift half your crypto to your spouse before selling it, you're effectively going to double the tax-free gain within your household. Totally legal. Just document it properly, the wallet transfer, the date, the value, and maybe tell your spouse what's going on. That always helps as well. Then we've got number 3, master the 5th of April trick. The UK tax year ends on the 5th of April. So if you sell on the 5th of April, it counts as this tax year. Sell on the 6th of April, it counts as the next tax year. 1 day difference. So number 3, master the timing, because that 1 day can give you a fresh 3,000 allowance, a lower tax band, or 12 extra months before you actually have to pay. Sometimes the most profitable thing you can do is wait 48 hours. Patience, panic selling, waiting and planning your sale is often more profitable than selling quickly out of emotion or urgency. At number 4 is your expenses. You're allowed to deduct what you originally paid, so the original cost, trading fees, gas fees. Now, these are, just to translate, these are transaction fees paid to process and validate transactions on blockchain. Just like a car needs petrol to move, your transaction needs gas to move through the blockchain. That's why it's called gas fees. Then exchange costs as well. If you've done 200 trades and ignored the fees, you could be significantly overstating your gains. And in crypto, just a few pounds per trade quickly turns into hundreds or even thousands in some cases I've seen. Now, let me show you a real example of how planning dramatically reduced a crypto tax bill based on a couple of actual client situations that I've seen. 2 crypto investors with similar circumstances and income realized 50,000 profit from crypto. So investor number 1 sells everything in 1 tax year using his 3,000 allowance, leaving 47,000 taxable. Because that gain added to their other income pushes them into the higher rate band, they pay 24% capital gains tax. So their total tax bill, 11,280. Now, let's look at investor number 2 who plans their disposals properly, also married, but plans their income extraction a little differently. Just before the 5th of April, they realized 3,000 of gains in their own name, tax-free. They transfer crypto to their spouse, who also realizes 3,000 of gains, also tax-free. Now that's 6,000 tax-free in the first year. After 6th of April, the new tax year begins, both allowances reset. They realize another 3,000 each. So that's another 6,000 tax-free. So straight away, 12 grand of gains are realized without any tax at all. That leaves 38,000 of remaining gains. They also realize 8,000 of losses from underperforming assets. That reduces the taxable gain to 30,000. Because they've spread the gains across 2 people and 2 tax years, along with their other income, both are remaining mainly, not fully, but mainly within the basic rate band. So instead of paying 24%, they're only paying 18% on the majority and 24% on some. Their total tax bill comes out at 5,760. Now compare that to investor number 1, who paid 11,280. That's a tax saving of nearly half, simply by using allowances, losses, and timings properly. But what if you could take it a step further? What if there was a way to improve your strategy even more by leveraging the unique benefits of a limited company structure? Now, this is a really common question, especially from people trading more frequently. Is it more tax efficient to trade crypto inside a limited company, particularly if you're swapping one coin for another a lot? Because personally, every time you swap crypto, it can trigger capital gains tax. So let's explore the difference properly. Firstly, whether you hold crypto personally or in a company, swapping one coin for another is still a taxable event. HMRC treats it as if you sold the first asset and bought the second one at market value. So there's no magic exemption, just because it's inside a company. But the way the tax is calculated and applied is different. When you hold crypto personally, you pay capital gains on your net gains above your 3,000 allowance. Depending on your income, that's typically 18% or 24%. And those gains are immediately taxed personally. Inside a limited company, there's no capital gains tax. That can be a disadvantage in some cases, but here it's not if you're swapping. Instead, the company pays corporation tax on its net profit, currently between 19% and 25%. But there's one big difference that no one ever really seems to consider. Inside a company, gains and losses are automatically offset against each other within the same accounting period. So, for example, let's say your company makes a 20,000 profit on Ethereum and a 15,000 loss on Solana. Your company doesn't pay tax on 20,000. It only pays tax on the 5,000 net profit. That makes trading inside a company cleaner from an accounting perspective. Here's where the real advantage comes in, and it's not about avoiding tax. It's about controlling when you pay personal tax, because inside a company, after paying corporation tax, the remaining funds stay inside the company. You don't pay personal tax until you extract the money, for example, through dividends, which means if your goal is to reinvest and grow your portfolio long term, a company allows your capital to compound in a more controlled way. Whereas personally, once you pay capital gains tax, that money's gone permanently from your investment pool. Think of it like this. Personal ownership is kind of like a vending machine. You press the button and immediately take the money out and tax applies straight away. A limited company is more like a vault. The money can stay inside, grow over time, and you decide when to access it. This makes companies particularly useful if you plan to reinvest profits long term, you don't need immediate access to the cash, or you're building wealth over many years. For example, it's a long-term strategy. But if your plan is to regularly withdraw profits for personal spending, company can actually create more tax for you overall. So the structure itself isn't better or worse. It's about matching it to your long-term goals. Now, if you're unsure which structure makes the most sense for your crypto activity, you can book a free quote with Helpbox using the link below, and we'll help you get everything structured and reported correctly. Crypto isn't invisible anymore. From 2026, global reporting rules will automatically share exchange data, HM revenue and customs. They don't need to guess. So the smart move isn't avoiding tax. You don't need to overpay, but you do need to get it right, because in crypto, volatility is optional, but tax penalties aren't. See you next time.